Hope everyone had a good week. I'm here with Charlie Jewett,
Hello.
founder of Renovating Retirement. And I wanted to kind of do a quick recap of our conversation yesterday or last week, the conversation that Bobby and I had, and then a little bit of updates, and then let Charlie sort of spin it off in a new direction, right? So last week, I spoke with Bobby about the Silicon Valley bank failure, and we touched on a whole bunch of stuff, how to talk to clients about it, but also just sort of understanding what happened, that they had invested in a bunch of fixed rate bonds. And so when they had to sell them, they had to do that at a discount, take a big loss, caused all these issues, et cetera, et cetera. So created this, which then created a run, and then we know what happens. It's been regurgitated a bunch of times. What has happened since then was an answer to the question of what happens to all of those depositors who had money above and beyond the $250,000 limit. And last Friday, when I went live with Bobby, it was still up in the air. We talked about FDIC insurance and making sure that you're talking to clients about that. If they have more than $250,000 in the bank, don't have it all in one bank, spread it between multiple banks so that it is all insured. And Monday, we got the sort of answer to the big question, right? What happens to all those depositors? And in this case, the conclusion was that they will have their deposits covered, which then raises the question, okay, so we're talking about a big bank. We're talking about a bank that made headline news and was this huge thing. What about the small banks? What about middle of podunk nowhere, small little local bank? Are those depositors also going to be covered if they have more than $250,000 in the bank? Is that number just a guideline? Because up until now, I thought it was supposed to be a rule. And what we were told was, well, it depends. It will be evaluated on a case-by-case basis, and
Mm-hmm.
it depends on essentially, and I'm paraphrasing here, but the social impact, right? Will it cause a panic? So to put it in kind of crude terms, hey, is the bank too big to fail? And if it's not, then you're just out of luck. But if it is, then great, we're going to bail you out because we want to not get bad press.
Comforting, isn't it? Like you lose your if it's not going to cause a panic, you can lose your money.
It is so disheartening.
Wow.
I mean, I bank at a local small bank, and I love it. The people are kind, and there's these additional services, and you walk in and it's very personal. But then it raises the question, like, okay, man, apparently like the rules are not applied evenly across the big and the small here. So it really, I think, brings up the conversation. And maybe this isn't necessarily a conversation that you're having with clients, but as a financial advisor, as someone that works in this financial space, you need to be looking and at kind of at the whole situation and looking at what you're talking to clients about and what they're saying to you, and being able to say, really, where is the risk? Because apparently not all banks hold the same risk. What about insurance companies? What is the risk associated with those? And how do you answer a client? And this is, Charlie, where you get to really chime in with all of your experience, is people are comfortable with banks, right? Even though we have seen how risky they are. But we have seen how risky they are, but yet they are so common that we're comfortable. We're comfortable putting our money in there. We're comfortable going there asking for financial advice. We're comfortable trusting that it's going to be safe, right? And so what about an insurance company? Because this is a place where clients aren't necessarily so comfortable, right? Even before any of the bank failures, I got questions all the time. Well, how secure is this? How do I know they're not going to go out of business? You know, what happens to my money? How protected is it? So speak to that a little bit. What do you say to clients? How do you respond to that concern? And how do you respond to it now when it's like on the forefront of everybody's minds?
It's such a funny conversation. And the whole thing with the banks failing is like, you could have chosen not to put more than $250,000 in there. You know, as an advisor, if you see somebody on their fact finder that has, you know, $500,000 in a bank, as you know, be like a fiduciary, whether you have the license or not, say like, well, one, let's not leave $500,000 in one bank.
Yes.
Let's at least, if you're going to lose interest on $500,000, let's like at least have the protection. You know what I mean? So, you know, banks and brokerage firms like the Joker brokers I talk about, Edward Morgan Lynch, you know, they've proven that the way you make people comfortable is not true safety. People lose money in the market. People lose money in the banks. The way you make people comfortable is you pay money for buildings and you pay money for commercials. You run commercials and tell them you've got 10,000 offices with $1 trillion under management. We'll lose your money and overcharge you, but we got a lot of buildings, baby, you know? So insurance companies, you know, they're all in Des Moines, Iowa, you know, or like I'm working with the oldest insurance company in Utah right now. I have a case with them. They have one building somewhere. They're not on the street corners. They're not on the commercials, right? But everybody that I've met with for the last 19 years has that concern. Anybody who's going to move 100,000, 200,000, 3 million, 10 million, 400 million, they're going to want to know where I'm moving, you know, where are we moving it to and can I lose it? That's very natural. Everybody you talk to as an advisor or an insurance agent is going to want to know that. So what you want to do is really understand the difference between insurance companies and banks. Banks are allowed to leverage. They're allowed to lend out more money than they have. You give them $100,000, they can lend 900 grand. Insurance companies have a number of different nets. You know, can you picture a trapeze artist or a circus or somebody that's like, you know, swinging high in the air, and if they fall to their death in front of the crowd, that would be horrible. So they usually put a net there, right? Well, what's net number one? Net number one is the reserve system, where the insurance company has to have all the money all the time. Let me use a personal example I use with clients all the time. If I have $1 million mortgage, I owe a bank $1 million, and it's $6,000 a month to service that loan, and I have a great job, great business, whatever, I'm paying my mortgage, and I lose my job or the business isn't doing well, and I can't make my payment of $6,000 a month. Am I in trouble? And if I was quiet there, people would wrestle with that. They might answer yes or no. Am I in trouble if I can't pay my mortgage payment? Well, the real answer, if I don't have the $1 million somewhere to pay off the debt, I'm in trouble because I can't pay off the debt or service it. But if I have $1 million in assets, like we teach our clients to have a mortgage and have money and make an arbitrage, if I can pay the debt off and it goes away so that I don't have to service it, I never have any risk. Ever. If you can pay off all your debts at any time, you're not going to go bankrupt. Insurance companies in the United States of America are forced to be 100% liquid at all times. They always have to have all of the money to pay off every human being. There's never been a run on the insurance companies. It's not a term we have because it doesn't happen. If a lot of people call in 1 week and say, cancel my policy, the insurance company cancels the policies and gives them their money back because it's sitting right there. So because of that, we have this situation where we've never lost an insurance company. You know, there was a time where everybody wanted to talk about AIG because AIG was in trouble. AIG was going bankrupt or whatever. AIG was in the news. So everybody wanted to talk about AIG. Well, it turns out AIG is not a life insurance and annuity company. They own one called American General. And AIG got in trouble for, I don't know, insuring the hand models and like whatever, wombats and stuff or whatever they were insuring, right? But American General, the insurance company that AIG owned, had the rules. They had to have all the money all the time, and they never had any problems. I know people with American General. You go back far enough, there's a company called Conseco that did some terrible things. They didn't even go out of business. So we don't lose insurance companies. So let me just use I like metaphors and analogies, but I don't know the difference. So let me just tell a story. I like fire insurance. I like fire insurance. Like if everything I own burns to the ground, I'd like you to give me some money and rebuild my house. That's cool.
Mhm.
If I had a choice, though, I'd like to live in a city that didn't have fires, that had never had a fire and basically theoretically couldn't have fires. I don't know if that means there's no oxygen and we live on the moon. I don't know what that means. You know what I mean? Like you can't have fires, but just make it up in your head. This town has no fires. Or like you go to Hawaii, there's no snakes and no skunks, no monkeys. Love it, right? Although monkeys are cute. But imagine, would you need fire insurance if there's no fire? The answer is no. So why don't we have FDIC insurance for insurance companies? Because we don't need it. They don't go out of business and take your money. You don't lose your invested principal. Any dollar that you take from somewhere, your mattress, your safe, your bank, your brokerage account, any dollar you take from somewhere and put it inside of an insurance company just got safer. It is the safest, the most safe, the safest place of all of the options historically and theoretically. Well, that's net number one. No one's ever even fallen on that net. We don't lose insurance companies. What's net number two? Reinsurance. Companies have to pay other insurance companies to insure them if they go out of business. What's net number three? The state guarantee fund. Is that the same as FDIC insurance? No, it's not. But it's a similar idea. If your insurance company goes out of business and they actually can't pay you, then there's a chunk. Every state says you can have up to $250,000 or $100,000. Or you can look up your state guarantee fund. It's not very likely that it's going to happen. Historically, certainly it's not anything that anybody's been using, but there are way more nets in the insurance industry. And no one ever asks me, Ada, no one ever has, in my entire career, I've probably met 10,000 families. In my entire career, no one has ever asked me, what if Edward Jones goes out of business? What if Fidelity goes out of business? What if Ameriprise goes out of business? What if Vanguard goes out of business? What if Bank of America goes out of business? What if blah, blah, blah? No one ever asks me about the safety of where the money already is. They only ask about the safety of where we're going to move the money to. And as it turns out, we lost 5,000 banks in the Depression and 0 insurance companies. Why is that? It's a totally different model. And it will make sense to you if you just understand. Can you imagine someone starts working at the age of 22, blue collar worker starts at the age of 22, pays into a whole life policy every month for 60 years? Well, not 60 years. You don't retire at 82. Starts at 22, pays into an insurance policy every month for 40 years, 62 years old, keeps paying the whole life, lives 20 years in retirement, dies at 82. So yeah, he did pay for 60 years. Can you imagine if the year before this person died, the insurance company had the right to go bankrupt and say, well, we're out of business, wash their hands of all the debt? What happens to all the money and all the compound interest that person paid and all the other families who've been paying for a death benefit? I only benefit when I die. That's a very long term. Can you imagine if the United States of America would allow insurance companies to go out of business when people have been paying for life insurance that pays when they're dead? By definition, these companies have to exist until the last client is dead and they keep getting new clients. They're not allowed to go out of business. Can we have an Armageddon scenario that changes the entire world where the US dollar isn't the currency and there's like mafia, like people running the streets with machine guns? Yes, but it's not happened. We don't know how to insure against something that's never happened. And financial planning and investment advice and insurance decisions are not for doomsday scenarios that have never happened. They're for as long as we have money and have a financial system, what should we do? Listen, having money sucks. And I say that kind of tongue in cheek. It's also pretty awesome. But having money creates problems. There used to be bandits, that would like rob your wagon when you were trying to travel and you had this big chest full of gold. There's something called pirates you guys have heard of. We still have them. Pirates in the oceans that attack boats. You put it in your house and it burns, right? If you've watched Narcos or any of those, you bury it in the ground, it gets wet and it destroys your dollar bills or whatever those were. And then those of us that have electronic money who live today, we don't keep it in bills and gold, most of it. You put it inside of companies and banks go out of business. Brokerage firms lose your money. I met somebody the other day. His account was $350 last year. Right now it's $225. He's 65 years old. wherever his broker had him, he went from $350,000 to $225,000 in losses in the market. The market, you lose money. Banks, you can lose money if they go out of business. You look at insurance companies and the products that we sell, that we offer to people, you don't lose money when the market goes down, and we've never had one go out of business and take the family's money. They've made every single annuity payment ever without missing a single one. Every state has a guarantee fund to insure them. There's reinsurance companies insuring them, and each company has all the money they need to pay all their debts anyway, so they're not in trouble. And by the way, insurance companies want money so much. They want your money. They want the client's money so much they pay us commissions to get it. They go backwards. To get $100,000, they pay us 7 or 8%. They only end up with $92,000. That's how bad they want the money. When an insurance company isn't doing well, instead of going out of business, guess what they do? They just list themselves for sale because all of the money they already have, and they've already paid commissions. Hello. They've already paid commissions. All that money they already have, where commissions have been paid, is an incredibly saleable asset. All the other insurance companies bid to try to buy that book of business, the way that if you manage money, you might buy another money manager's book of business. Insurance companies don't go out of business because they already have all the money. It's a saleable asset if they get in trouble and everybody wants them. There's reinsurance companies. There's a state guarantee fund. We have to look at history. Okay, I don't buy flying cow insurance because I've never had a cow fly through my house. And there's no need to insure against insurance companies going out of business because it hasn't happened yet. Even though it hasn't happened yet, we actually do have several layers of insurance against it happening that have never needed to be used. So I notice on my side that Ada is not here and she must be having problems with her internet. So hopefully it's streaming live, and I'll wrap it up here. But as you're talking to clients, make sure that you can be educated enough to be able to give comfort to the consumer, give comfort to your prospect, to give comfort to your client and say, I share the concern with you. Having money is a problem. I share the concern with you. And when we're moving big money, you really want to ask these questions. But let's look at banks, brokers, and insurance companies and see, where is the safest place to have money if everything goes to crud? The stock market goes straight down. Where is the safest place to have money? And it turns out that it is insurance companies, and you can actually print, whether it's a vital signs report, that's the one I'm familiar with. Maybe there's other providers, but something called vital signs, or you can go right to the insurance company's website. You can actually print their financials and say, look, we have $61 billion in liabilities, and we have $64 billion sitting in the general account. That's $3 billion more than we need. We have a reserve, and then there's all the other nets. So we'll wrap it up there. You're the leader. You're the coach. When you meet that prospect, you look them right in the eye and you say, I know what to do. If you want your money in the market, just gambling up and down with a fee, I'm not your person. Or if you do that, say that we don't want all the money there. You tell them alternative investments are beating the market for the last 23 years. And every dollar you move is not only safer from losing it if the institution goes out of business, but safer because there's no market losses. So do you want that kind of comprehensive advice, or you just want to buy some more mutual funds? They say they want that advice and you give it to them. So happy Financial Friday. We'll see you next week.